Welcome to Optimize Your Fitness Business, Tax Hacks for Trainers. I'm thrilled you're here because you're about to learn strategies that can truly transform your financial game as a fitness professional. Imagine being able to confidently approach tax season, knowing you're maximizing every deduction available to you, keeping more of what you've earned, and setting up a stable financial foundation for your business. Whether you're a personal trainer, a gym owner, or even running a virtual fitness program, these strategies are designed specifically to help you thrive. Why this course will change the way you think about taxes. Let's be real, taxes aren't the most exciting part of running a fitness business, but understanding the right strategies can mean the difference between just getting by and building a truly profitable business. Taxes don't have to be confusing or intimidating. In fact, they can actually become an asset for you once you know how to use them to your advantage. And that's exactly what this course is here to do. What we're going to cover isn't just the standard tax tips you can find online. This course is packed with creative, hands-on strategies that you can start using immediately. You'll gain insights into specific tax deductions available to fitness professionals that most people aren't even aware of. Plus, I'll guide you through the entire process of setting up a tax-efficient business structure, which becomes especially valuable as your business grows and evolves. What you'll get out of this course. By the end of this course, you'll have practical knowledge you can apply right away. Here's a sneak peek of what you're about to dive into. Maximizing your deductions. We'll kick things off by diving into tax deductions you might not have realized were possible. You'll learn how to make the most of your expenses like gym equipment, training spaces, travel, and even specific client-related purchases. Think of every piece of equipment, every training session, and every mile traveled as potential savings. Using your space to your advantage. If you use any part of your home for training, consultations, or even just for business planning, that space could be working for you as a deduction. I'll show you how to optimize deductions whether you're training clients in a full-scale gym, in a home office, or even in a garage setup. It's all about finding those extra savings that are already within reach. Creative and unconventional deductions. This is where it gets really exciting. Beyond the basic deductions, there are unique opportunities specifically for fitness professionals. Things like branded fitness gear, client wellness incentives, and even some professional development expenses can potentially be deducted. Imagine being able to write off more of what you already spend in your day-to-day work. These aren't just theoretical ideas, they're practical, out-of-the-box solutions that will directly impact your bottom line. Choosing the right business structure. As your business grows, having the right business structure in place can make a huge difference in your tax efficiency. We'll go over the benefits of different structures like sole proprietorships, LLCs, and S-Corp, so you can choose the best option for your specific goals. You'll learn how to adapt your structure as your income increases, helping you avoid unnecessary taxes and focus on what matters growing your business. Risk management insights. Beyond just tax strategies, this course will also touch on risk management, an essential part of any sustainable business. We'll briefly cover how to identify potential risks to your income, your assets, and your business operations. And if you want to go deeper, I offer a dedicated course on risk management tailored specifically for fitness professionals. It's all about making sure your hard work is protected so you can focus on building your business confidently. Year-end tax planning. The year-end can be a powerful time to maximize your tax strategy. We'll cover key steps to take before December 31st to lock in deductions, set yourself up for the upcoming tax season, and ensure that you're fully prepared. These strategies will give you peace of mind and help you avoid last-minute scrambles that so many business owners face. What to expect throughout the course. This isn't just a course full of theory, it's hands-on and built for real application. In each module, I'll be walking you through examples and case studies based on real-life scenarios. You'll see exactly how these strategies have worked for other trainers and fitness business owners just like you. I'll also be giving you worksheets, reflection questions, and step-by-step guidance, so you can apply what you're learning to your own business immediately. Plus, throughout this course, I'll share fun facts and insights that make tax strategies feel a bit more exciting. For example, did you know that even your business-related wardrobe, like branded fitness gear, can potentially be deducted if it's specifically used for promotional or business purposes. This is one of the creative deductions we'll explore together. Get ready to transform your approach to finances. I want you to feel confident and empowered by the end of this course, knowing that you have the tools to save money, optimize your tax strategy, and focus on what you love: training and transforming lives. So, whether you're just starting out or you've been running your business for years, I promise you'll find insights and strategies here that will make a real difference. So, let's dive in and unlock the tax savings you didn't even know you had. I'm excited to get started. Let's go. Hi, I'm Keena Spencer, and I'm thrilled to be your guide in this course on tax strategies tailored specifically for fitness professionals. I've been a tax strategist for over 20 years, and during that time, I've helped small business owners and entrepreneurs from nearly every industry save money and optimize their taxes. But what really excites me is working with fitness professionals like you, trainers, gym owners, and wellness coaches who are dedicated to transforming lives and improving health. Early in my career, I noticed that many professionals in the fitness industry were missing out on tax savings simply because they weren't aware of the unique deductions and strategies available to them. It became my mission to simplify these complex tax laws and create strategies that anyone, from a solo trainer to a studio owner, could understand and use to their advantage. That's why I'm here to help you not only keep more of what you earn, but to build a more profitable, sustainable business that supports your goals and growth. In this course, I'll be sharing practical, real-world strategies that I've developed and refined over the years. We'll cover everything from the foundational tax rules that every trainer should know to more advanced, outside-the-box ideas. I'll walk you through how to take deductions on things like gym equipment, travel, even your branded fitness gear, and show you how to maximize your space, whether you're training clients in a gym, at home, or even virtually. One thing I love about working with fitness professionals is the passion you bring to your work. You're committed to making a difference in people's lives, and I believe that's something worth supporting. I'm here to give you the tools and strategies you need to make smarter financial decisions and ultimately keep more of what you've worked so hard to earn. In this course, you can expect hands-on learning with practical examples and real-life case studies. I've designed it to be as engaging and actionable as possible so you can start implementing these strategies right away. I want you to feel empowered to handle your taxes confidently, whether you're just starting out or looking to take your business to the next level. Thank you for joining me on this journey. I can't wait to help you unlock the potential tax savings you didn't even know you had, and to see how these strategies can make a real difference in your fitness business. So let's dive in and get started. Now that you know a bit about my background and why this course was created, let's take a closer look at what you'll be learning in each module. This course is packed with practical strategies that you can start applying immediately, and each module is designed to build on the last, giving you a complete toolkit for optimizing your tax strategy as a fitness professional. Let's break it down so you know exactly what's in store. Module 1, Introduction to Financial Health. We're starting with the essentials in this module. Here, you'll learn the foundation of financial health for your fitness business. You'll discover how to think about your finances strategically and set yourself up for long-term success. We'll touch on why having a financial plan is critical and how understanding your cash flow, deductions, and business expenses early on can save you thousands down the line. Module 2, Choosing the Right Business Structure. Choosing the right business structure is crucial for maximizing tax efficiency, especially as your income grows. In Module 2, we'll dive into the different structures available, like sole proprietorship, LLC, and S Corp, and help you figure out which one is right for you. We'll go over the pros and cons of each structure and show you how to adjust your setup as your business evolves. This module is all about setting a strong foundation so you're ready to scale without taking on unnecessary tax liabilities. Module 3, Key Deductions for Fitness Professionals. In this module, we're going beyond the basics and exploring deductions that are specifically valuable to fitness professionals. You'll learn about deductions for gym equipment, travel, client-related expenses, and even your branded fitness gear. We'll also cover how to use your space, whether it's a home office, gym, or training studio, to maximize deductions. By the end of this module, You'll have a clear understanding of how to claim these deductions with confidence and reduce your taxable income significantly. Module 4. Managing Cash Flow and Financial Health. Module 4 focuses on maintaining a healthy cash flow and improving your overall financial health. We'll talk about how to manage the money coming into and going out of your business and how to ensure you're consistently profitable. You'll learn how to use financial ratios to monitor your business health, improve your cash flow timing, and develop creative strategies for stabilizing income. This module is all about financial stability, so you can make proactive decisions and keep your business running smoothly. Module 5. Brief Risk Management Overview. While this course focuses primarily on tax and financial strategies, it's essential to touch on risk management briefly. In Module 5, we'll discuss the basics of identifying and mitigating risks that could impact your fitness business, from financial and legal risks to operational issues. And if you want to dive deeper, there's a full course available that's dedicated to risk management strategies for fitness professionals. This module will give you the starting points to protect your business while staying focused on growth. Module 6. Year-end Tax Planning Strategies. Our final module is all about wrapping up the year on a high note and ensuring you're fully prepared for tax season. We'll cover the key steps you need to take before December 31st to maximize your deductions and minimize tax liabilities. This includes strategies like accelerating expenses, organizing income and expenses, and planning for retirement contributions. By the end of this module, you'll have a clear, actionable year-end checklist that will make tax season a breeze. What you'll get out of this course by the time you complete this course, you'll have a solid understanding of the specific tax strategies that apply to your business as a fitness professional. You'll know how to maximize your deductions, optimize your business structure, maintain healthy cash flow, and protect your business from unexpected risks. And most importantly, you'll feel confident about approaching tax season with a proactive, strategic mindset. Every module in this course is designed to be actionable with real-world examples and exercises that make it easy to implement these strategies in your own business. I'm here to support you through each step and help you take control of your finances so you can focus on what you love, transforming lives and growing your fitness business. Thank you for joining me on this journey. Let's dive in and start building a profitable, sustainable future for your fitness business. Understanding your tax obligations is the foundation of any good tax strategy. Whether you're an independent contractor, operating your own gym, or working with clients virtually, there are specific taxes and reporting requirements that apply to you as a fitness professional. By knowing and managing these obligations, you can avoid costly mistakes and focus on building a profitable business. Taxes may not be the most exciting part of running your business, but they are absolutely essential. Ignoring them or delaying your tax responsibilities can lead to penalties, interest, and even legal issues. This lecture is all about setting you up for success by breaking down what you need to know to stay compliant, minimize tax-related stress, and protect your income. Key tax obligations for fitness professionals. Let's dive into the 3 major tax responsibilities every fitness professional should know: self-employment taxes, quarterly estimated payments, and business forms. Each of these plays a critical role in ensuring you meet your tax obligations, and understanding them will set you up for more advanced strategies later on. The first one, self-employment taxes. As a fitness professional, the IRS typically classifies you as a self-employed individual. This means that unlike traditional employees, you're responsible for paying both the employee and employer portions of Social Security and Medicare taxes, collectively known as self-employment tax. For most, this comes as a surprise. Self-employment tax is currently 15.3%, covering Social Security and Medicare. Half of this would be covered by an employer if you were traditionally employed, but as a self-employed professional, you're responsible for the full amount. It's essential to plan for this additional tax obligation, as it can significantly impact your income if you're unprepared. Why this matters. For a fitness business, self-employment tax can add up quickly, especially as your income grows. By being aware of this obligation early on, you can set aside funds and make adjustments that will keep you financially prepared. We'll go over strategies in future modules to help you minimize this tax burden, but understanding it now is the first step. The second one is quarterly estimated payments. In addition to self-employment tax, self-employed individuals are required to make quarterly estimated payments to cover their federal income tax and self-employment tax. Unlike traditional employees who have taxes withheld from their paycheck, you're responsible for calculating and sending payments to the IRS every quarter. The IRS requires quarterly estimated payments if you expect to owe $1,000 or more in taxes for the year after accounting for withholding and credits. Missing these payments or underpaying can lead to penalties and interest charges. But here's the good news. If you understand this obligation and set up a system to handle it, you can avoid these penalties and stay in control of your cash flow. Tips for managing estimated payments. Set up a separate tax account. Consider setting aside a portion of each payment you receive in a separate account dedicated to covering taxes. This can make it easier to manage cash flow and prevent spending money you'll need for taxes later. Calculate in advance. Using accounting software or consulting with a tax advisor can help you calculate estimated payments accurately. The IRS also provides worksheets to guide you, though they can sometimes be tricky to navigate. And lastly, business forms and filing requirements. The way you file your taxes depends on the structure of your business. If you're a sole proprietor, you'll likely file a Schedule C along with your personal income tax return to report your business income and expenses. However, as your business grows, other structures like an LLC or S Corp might offer additional tax benefits, such as separating your personal and business income and allowing you to save on self-employment taxes. Choosing the right structure and understanding how it affects your tax obligations is crucial. For example, sole proprietorships and LLCs. These structures are simpler to manage, but as a sole proprietor or single-member LLC, you'll still pay self-employment tax on your net income. S Corp. As an S Corp, you can choose to pay yourself a reasonable salary and take the remainder as distributions, which aren't subject to self-employment tax. However, this structure has additional requirements and may not be right for everyone. Later in this course, we'll dive deeper into these options to help you determine what's best for your specific situation. But for now, it's important to understand the basics so you can decide which structure fits your current needs. Fun fact: did you know that the IRS views personal trainers as self-employed individuals, which means you're responsible for not only your income tax, but also your self-employment tax? In other words, being a self-employed trainer means you're effectively paying twice the Social Security and Medicare taxes that a traditional employee would. That's why learning how to minimize your tax liability is so important. Small changes in how you manage your business can lead to big savings. Let's look at Jake's story. Jake is a trainer I worked with who was new to the world of self-employment. When he first started, he wasn't aware that he needed to make quarterly estimated payments or set aside money for self-employment tax. He thought, I'll just pay everything at tax time, not realizing that by waiting, he'd be hit with a hefty tax bill and penalties for underpayment. After a rough first year, we set up a system for Jake to stay on top of his tax obligations. We calculated his estimated quarterly payments, set aside funds for self-employment tax, and helped him plan his cash flow more effectively. By setting up this system, Jake not only avoided penalties, but also saved over $3,000 in taxes. He reinvested this money back into his business, allowing him to upgrade his equipment and expand his client base. Jake's story is a great reminder of the importance of understanding your tax obligations early. This course will help you avoid similar mistakes and give you the tools to stay on top of your responsibilities without stress. What's next? Now that you have a basic understanding of the tax obligations you'll be managing as a fitness professional, you're ready to dive deeper. In the upcoming modules, we'll explore ways to maximize deductions, optimize your business structure, and manage cash flow so that you're always prepared. Each step you take will build on these foundational principles, helping you keep more of what you earn and grow your business with confidence. Thank you for taking this time to understand your tax responsibilities. It's an essential part of running a successful business. Let's continue this journey together and start turning these principles into actionable strategies that work for you. Welcome to Module 2. Now that you have a foundation in your tax obligations, we're ready to take the next step, choosing the right business structure. Your business structure affects not only your taxes, but also your legal protection, financial growth potential, and operational flexibility. Choosing the right structure is a critical decision that impacts how you pay taxes, manage profits, and set yourself up for long-term success. As a fitness professional, you're building something unique, whether it's a solo practice, a growing client base, or even a full-scale fitness studio. Your business structure can help you maximize tax benefits, protect your personal assets, and open doors for expansion. Let's dive in and explore the main structures available to you so you can make the best choice for your business. Why your business structure matters. Many business owners, especially in the early stages, overlook the importance of structure. It's easy to think, I'll just stick with a simple setup for now and figure it out later. But your structure is more than just a formality. It's a foundation that can set you up for greater financial health and flexibility. With the right structure in place, you can reduce your tax burden, minimize legal risks, and be prepared to adapt as your business evolves. Understanding your options. Let's explore the main business structures available to fitness professionals: sole proprietorship, limited liability company LLC, and S corporations corp. Each structure has its own set of advantages and potential drawbacks, and knowing the differences can help you choose the one that best aligns with your goals. 1. Sole proprietorship. A sole proprietorship is the simplest business structure. As a sole proprietor, you and your business are legally considered the same entity, meaning there's no separation between your personal assets and your business assets. While this structure is straightforward and easy to set up, it does come with some limitations. Pros. A sole proprietorship is easy and inexpensive to start with minimal paperwork. You'll file your business income and expenses on your personal tax return using a Schedule C, making tax filing relatively simple. Cons. Since there's no legal separation between you and your business, your personal assets are at risk if your business faces financial or legal issues. Additionally, sole proprietors are responsible for paying self-employment tax on all business income, which can be a significant expense as your income grows. When to choose sole proprietorship. A sole proprietorship is often the best choice for fitness professionals who are just starting out or operating on a small scale with minimal expenses and no employees. It offers simplicity and flexibility, but may not be ideal for those looking to grow or protect personal assets. 2. Limited liability company LLC. An LLC offers a step up in terms of legal protection and flexibility. By forming an LLC, you create a separate legal entity for your business, which protects your personal assets in case of business liabilities. This is particularly valuable in an industry where legal risks like client injuries or equipment damage are a concern. Pros. An LLC protects your personal assets from business liabilities, provides tax flexibility, and allows for growth. It's easier to establish than a corporation and allows you to choose whether to be taxed as a sole proprietor or an S corp, which we'll discuss shortly. Cons. An LLC has higher costs and administrative requirements compared to a sole proprietorship, including state filing fees and annual reporting. In some states, LLCs also incur additional taxes, such as franchise fees. When to choose an LLC. An LLC is ideal for fitness professionals who want to protect their personal assets and have flexibility in tax structure. It's a great choice for trainers with a growing client base, additional trainers or employees, or those who own or lease a physical location. As an LLC, you can continue as a single-member business or add partners as you expand. 3. Corporations Corp. An S corp is a specific tax designation that allows you to structure your business in a way that can reduce self-employment tax. S corp owners can pay themselves a reasonable salary and take additional profits as distributions, which aren't subject to self-employment tax. This structure is beneficial for fitness professionals earning a higher income and looking to optimize tax efficiency. Pros: S Corp owners only pay self-employment tax on their salary, not on distributions, which can save thousands of dollars in taxes. S Corp also offer liability protection and make it easier to add partners or raise investment if you decide to grow. Cons: S Corp have more administrative requirements, including payroll, corporate tax filing, and strict guidelines around owner salary and distributions. You may also need professional guidance to maintain compliance, which adds to your costs. When to choose an S Corp? An S Corp is generally best for fitness professionals who have established a steady income and want to reduce self-employment tax. It's also a solid choice for trainers looking to expand and bring on additional trainers or partners. While the setup is more involved, the potential tax savings can be substantial if you're earning a consistent profit. To make these options a bit clearer, let's look at a real-world example. Meet Sarah, a personal trainer who started her business as a sole proprietor. At first, this was the perfect structure. Sarah didn't have employees, her expenses were manageable, and tax filing was simple. However, as her business grew and she opened her own training studio, she realized she needed more protection and tax efficiency. After discussing her options, Sarah decided to form an LLC. This change protected her personal assets and allowed her to add another trainer as a partner. Within a year, Sarah's income increased and she began earning more than she needed to reinvest. We reviewed her goals and she decided to switch to an S Corp. By taking a reasonable salary and receiving the rest of her income as distributions, Sarah was able to save over $5,000 on self-employment taxes alone. The choice to switch to an S Corp paid off quickly and gave Sarah the structure she needed to keep growing her business confidently. Sarah's story highlights the importance of choosing a structure that fits your current stage and being open to adjusting it as your business evolves. Your business structure isn't something you set and forget. It's a tool you can use to adapt as your goals and income grow. Questions to ask yourself when choosing a structure. As you think about which structure is right for you, consider the following questions. What are my growth goals? Are you planning to stay small or expand to a larger client base, hire employees, or open additional locations? How much protection do I need? Do you want to protect your personal assets from business risks, especially if you own equipment, lease space, or work with clients in high-impact environments? What is my income level? If you're generating a higher income, an S Corp could help you reduce taxes by limiting self-employment tax to your salary alone. What's next? In the next modules, we'll start exploring how to leverage your chosen structure to maximize deductions, manage cash flow, and streamline tax obligations. Remember, your structure is a foundation, and everything we cover moving forward will build on this choice. As you consider which option is right for you, keep in mind that there's no one-size-fits-all answer. The best structure is the one that aligns with your unique goals and needs. Thank you for investing the time to understand your options. Making informed decisions about your business structure is one of the most powerful steps you can take toward long-term financial success. Now, let's move forward with a strong foundation and start building a tax strategy that works for you. Let's jump into one of the most flexible and powerful tools available for fitness professionals, the LLC. If you're ready to protect your personal assets, reduce your tax burden, and set up a foundation for growth, an LLC could be exactly what you need. Think of it as your business's protective armor and strategic ally all in one. Personal asset protection. In the fitness world, you work with clients in settings where physical activity, equipment, and even simple movement can increase risks. One major advantage of an LLC is the separation it creates between your personal and business assets. With this structure, your home, car, and savings are shielded if any business liabilities arise, like a client injury. Why this matters: think of it like the guardrails on a mountain road. They keep you safe, no matter how winding the journey becomes. This protection is invaluable for fitness professionals, especially those who own or lease space or have equipment that clients use. Tax flexibility. LLC as a pass-through entity. An LLC gives you unique tax options. It's a pass-through entity by default, meaning profits pass directly to you and you report them on your personal tax return. But here's where it gets exciting. LLCs offer the flexibility to choose how you're taxed. If your income grows, electing S Corp taxation might allow you to save thousands by limiting self-employment tax to just your salary portion. For example, meet Sarah, a studio owner. When her income increased, she made an S Corp election for her LLC and saved over $7,000 on self-employment taxes by taking a salary and additional income as distributions. Deductible business expenses for LLCs. Operating as an LLC allows you to leverage a wide range of deductible expenses, including training equipment, from weights to mats, deduct it all. Home office, deduct part of your rent, utilities, and more. Travel and education, claim expenses for conferences, certifications, and professional development. Tip: keep detailed records. It's like giving your business a savings boost every time tax season comes around. Profit distribution and reinvestment. With an LLC, you have flexibility in handling profits. Not only can you distribute profits to yourself, but you can also reinvest them into your business strategically. This is a perfect setup if you're planning to expand, hire, or upgrade your equipment. For example, Alex, a coach, reinvested his profits into marketing, equipment, and staff training, doubling his client base in 1 year. Credibility and professionalism. Beyond tax and asset benefits, operating as an LLC enhances your business's professional image. An LLC designation tells clients and partners that you're serious about what you do, which can open doors to new clients and collaboration opportunities. In summary, an LLC structure gives you more than just protection. It's a launchpad for growth, tax efficiency, and professional credibility. As you progress, these foundational choices will help keep you protected and set you up for sustainable success. Ready to maximize these benefits? Let's continue building on this foundation, crafting a strategy that works for you and your fitness business. Sometimes the next step in growing your fitness business is not just about bringing in more clients, but optimizing the structure that supports your growth. One of the biggest shifts that fitness professionals can consider is electing to be taxed as an S Corporation Corp. But when is the right time to make this change, and how do you know if it's right for your business? Let's break it down so you can make an informed decision that fits your goals, your revenue, and your future growth. Why switch to an S Corp? An S Corp structure can provide major tax savings, especially as your income grows. It allows you to split your earnings between a salary, which incurs self-employment tax, and distributions, which don't, reducing the amount you pay in self-employment tax. Imagine keeping more of your earnings while setting your business up for better scalability. That's the power of an S Corp. Key signs: it's time to consider an S Corp. Here are 3 indicators that your business might be ready to make the switch. Your income has grown significantly. If your business is generating consistent, high revenue, the S Corp structure could help you save thousands in self-employment tax. Typically, the S Corp election becomes advantageous if your business nets at least $50,000 annually. This threshold is a general guideline. The tax savings become more noticeable as your income increases beyond that point. You're ready to pay yourself a reasonable salary. To take advantage of an S Corp election, you'll need to pay yourself a reasonable salary based on what trainers in your area typically earn. This isn't just a recommendation, the IRS requires it. Once you've determined that you're ready to pay yourself a consistent salary, you can take the rest of your income as distributions, which aren't subject to self-employment tax. You're looking to grow and add partners? If you're considering adding trainers, bringing on a business partner, or scaling your fitness business, an S Corp structure provides flexibility in how you handle profits and contributions. With an S Corp, you can more easily add shareholders and partners, giving your business a structure that supports growth. The tax savings of an S Corp. Let's look at the example of Marcus, a personal trainer with an LLC who has been growing his business for a few years. Last year, he earned $80,000 in net profit. Initially, Marcus was paying self-employment tax on the entire amount, which came to over $12,000. After consulting with a tax advisor, Marcus decided to elect S Corp status. He set a reasonable salary of $50,000 for himself, which was subject to self-employment tax, but the remaining $30,000 he took as a distribution, which wasn't. This shift saved him over $4,000 in self-employment taxes for the year. Now, Marcus can reinvest those savings back into his business, whether that's new equipment, a marketing boost, or additional certifications. Marcus's story highlights how impactful the S Corp election can be when your business is bringing in significant income. How to make the switch S Corp election steps. Switching to an S Corp isn't difficult, but it's essential to follow the right steps to make sure your election is valid and beneficial. File IRS Form 2553. To make the switch, you'll need to file Form 2553, Election by a Small Business Corporation, with the IRS. This form notifies the IRS that you want your LLC to be taxed as an S Corp. Set up payroll. As an S Corp owner, you'll need to start paying yourself a regular salary through payroll. This means you'll have to withhold and pay federal and state payroll taxes. It may sound complex, but payroll services can simplify this process. Stay compliant with reporting requirements. Once you're an S Corp, there are additional reporting requirements, such as filing an annual corporate tax return form 1120S. Staying compliant is key to maintaining your S Corp benefits. Tip: consider working with a tax professional to ensure you're setting up and managing your S Corp correctly. This structure can save you significant money, but compliance is crucial. Questions to ask before switching. Before making the leap, here are a few questions to help you determine if an S Corp election aligns with your business needs. Can I afford a reasonable salary? For an S Corp to be beneficial, you should be prepared to pay yourself a salary comparable to industry standards. Do I have a stable income? An S Corp is best for businesses with steady revenue, as payroll and compliance requirements can add complexity if income fluctuates dramatically. Am I comfortable with additional reporting? The tax savings of an S Corp come with some administrative responsibilities. If you're prepared to meet those requirements, the benefits can outweigh the added complexity. Common misconceptions about S Corp. I can take my entire income as distributions. This is a common misunderstanding. The IRS requires S Corp owners to take a reasonable salary before taking distributions. Skipping this step can lead to IRS audits and penalties, so it's crucial to get it right. I'll automatically save money by switching. An S Corp election isn't always a guaranteed money saver. It depends on your income level, salary requirements, and other factors. If your income isn't high enough to justify the payroll and administrative costs, an S Corp might not be the best fit. It's complicated to maintain an S Corp. While there are additional steps, maintaining an S Corp doesn't have to be overwhelming. With a payroll service and proper planning, you can manage the requirements smoothly. Plus, the tax savings can make it well worth the effort. Maximizing the S Corp benefits as you grow. Once you've switched to an S Corp, there are several ways to maximize the benefits. Stay on top of payroll. Ensure your salary reflects industry standards and keep up with payroll filings. Reevaluate regularly. Periodically assess your salary and distributions to maximize tax savings and stay compliant. Plan for growth. As you scale your business, the S Corp structure will continue to provide tax advantages, especially as you add new revenue streams or partners. In summary, switching to an S Corp can be a powerful tool for fitness professionals looking to scale their businesses and save on taxes. It's all about timing and preparation, making the switch when your income supports it and following through with the required reporting. Choosing an S Corp can give you more flexibility, greater tax efficiency, and the structure to grow with confidence. If you're at that point in your business journey, it could be the right next step to take your business to new heights. Ready to keep exploring your options? Let's dive deeper into the strategies that help fitness professionals create financially sustainable, scalable businesses. When it comes to promoting your fitness business, creativity and branding are everything. What many trainers don't realize, however, is that some of their marketing and branding expenses can serve a double purpose, not only enhancing their business, but also saving them money on taxes. In this lecture, we'll dive into some uncommon deductions for marketing and branding that can help you keep more of what you earn while boosting your visibility and client base. Every dollar you invest in promoting your brand can become a tax-deductible expense, and knowing the ins and outs of these deductions can make a significant difference. From branded clothing to social media advertising, let's explore the unique deductions that you, as a fitness professional, should take advantage of. Branded apparel and uniforms. One of the more creative deductions available to fitness professionals is branded apparel. If you're wearing clothing with your business name, logo, or tagline while training clients, attending events, or creating content, it may be deductible as a marketing expense. This applies to any clothing you use specifically to promote your brand. What qualifies? Apparel like t-shirts, hoodies, leggings, or hats featuring your logo, website, or tagline, provided they are worn for business purposes. Keep receipts for all branded apparel purchases and make a note of how you use these items to promote your business. This can be helpful if questions ever arise. Say you spend $300 on branded t-shirts, hoodies, and hats that you wear during sessions and client events. These expenses are deductible because they are exclusively used to promote your brand while you're on the job. Social media advertising and content creation. For fitness professionals, social media isn't just a hobby, it's a primary way to reach clients, showcase expertise, and build brand recognition. Any expenses related to social media advertising, promoted posts, or content creation for business purposes can be deducted. Deductible expenses: the cost of running Facebook or Instagram ads, hiring a photographer or videographer, purchasing stock images, or paying for editing software. If you use software specifically for content creation or social media management like Canva or Hootsuite, these subscriptions can also be deducted as business expenses. Let's look at Alex, a trainer who runs a campaign to promote his online fitness classes. He spends $200 on Instagram ads, $100 on a photographer, and $20 on editing software. All these costs qualify as deductible marketing expenses, reducing his taxable income. Sponsorships and event fees. Participating in or sponsoring local events, such as wellness fairs, fitness expos, or charity runs, not only raises your business's profile, but can also be deducted as a marketing expense. Sponsorship fees, booth rental costs, and promotional giveaways are all eligible. What's deductible? Fees for event participation, booth setup, banners, and promotional items like branded water bottles or wristbands handed out during events. Keep records of event participation, receipts for booth rental, and invoices for promotional items. Suppose you spend $500 to sponsor a booth at a local fitness expo and another $200 on branded water bottles to give away. Both of these expenses are deductible, allowing you to promote your brand while reducing your tax burden. Professional photography and video production. If you've ever hired a professional photographer or videographer to capture your sessions, shoot promotional videos, or produce social media content, you can deduct these expenses as a marketing cost. High-quality visuals are essential for branding in the fitness industry, and the IRS recognizes this as a legitimate business investment. What qualifies? Hiring photographers, videographers, and editors for branded content, as well as renting studios or equipment specifically for creating promotional material. Even small equipment costs, like lighting or tripods, may qualify as deductible if they're used exclusively for your promotional work. Let's take Sam, a trainer who invests $600 in a video production to showcase his signature bootcamp. Since this video is used solely for marketing his services, the entire expense can be deducted, providing Sam with both a valuable branding asset and a tax benefit. Website and branding design. A website is often the first impression potential clients have of your business, making it a critical part of your brand. The costs associated with designing, maintaining, and updating your website are deductible as business expenses. This can include paying a designer, purchasing a domain, or even using website building platforms like Wix or Squarespace. Deductible expenses: web design fees, domain registration, website hosting fees, graphic design, and even content writing if you hire someone to manage your site. Keep all receipts for these expenses, along with any invoices or contracts from designers or developers you hire. Sarah, a yoga instructor, spends $1,000 on a professionally designed website. Since the website directly promotes her business and client services, this entire cost is deductible as a marketing expense. Networking and membership fees. If you're part of professional organizations, networking groups, or fitness industry memberships that enhance your visibility or lead to new clients, these fees are often deductible as business expenses. Many fitness professionals overlook this, but any membership that connects you to your community or potential clients is a valuable marketing investment. What qualifies? Fees for joining local chambers of commerce, fitness associations, or professional networking groups. Even online memberships or subscriptions to industry-specific websites can be deducted if they're essential to promoting your business or expanding your network. Jake, a personal trainer, pays $150 annually to join a local health and wellness network. This membership connects him with other professionals, leading to new client referrals. Since the membership fee directly supports his business growth, it's deductible. Emily's branding boost. Emily is a fitness coach focused on expanding her online presence. She invests in several branding-related expenses throughout the year: $400 for a professional photographer, $300 on branded fitness apparel, and $150 on Instagram ads. By strategically investing in her brand, Emily not only strengthens her online presence, but also saves on taxes by claiming these as marketing deductions. At tax time, she deducts a total of $850 from her business income, effectively lowering her taxable income and reinvesting in her brand. Best practices for claiming marketing and branding deductions. To make the most of your marketing and branding deductions, here are a few tips to ensure accuracy and compliance. Keep detailed records. Always keep receipts, invoices, and records of each expense. Note how each item or service directly promotes your business. Separate business from personal. Only expenses used solely for business purposes are deductible. If you purchase branded apparel, for example, make sure you're only wearing it for business events or client interactions. Track digital advertising costs. If you're running ads on multiple platforms such as Instagram, Facebook, or Google, keep a log of each ad spent to simplify deduction tracking. Bundle small purchases. If you're purchasing supplies like branded fitness gear or event items, try to buy in bulk or from the same vendor. This can help consolidate receipts and make record keeping easier. Common pitfalls to avoid. Mixing personal and business expenses. Avoid deducting clothing, travel, or other expenses that aren't exclusively used for business. Personal expenses won't qualify. Forgetting subscription costs. Subscription fees for design software, stock images, and digital tools used for business are all deductible, but they're easy to overlook. Not documenting usage. If you buy branded apparel or create content, keep notes on how these items are used for business. This can be helpful if you ever need to explain their relevance to your brand. In summary, marketing and branding expenses are essential investments in your business, and knowing how to deduct these costs can provide a major financial advantage. From branded apparel to social media advertising, these deductions help you reach more clients and strengthen your brand while keeping your tax burden lower. Remember, every dollar you spend on your brand doesn't just build your reputation. It's a chance to reduce your tax bill. Use these uncommon deductions wisely, and you'll be better positioned to reinvest in your growth and keep building a strong, recognizable brand. Up next, we'll continue exploring ways to maximize deductions that may be unique to fitness professionals. Let's keep uncovering opportunities to save and grow your business. As a fitness professional, your work may take you beyond the gym or studio. Whether you're driving to client sessions, attending workshops, or scouting locations, your travel can be a valuable tax deduction. In this lecture, we're diving into vehicle and travel deductions, a crucial area where trainers can save significantly. By understanding what qualifies as deductible travel, you can keep more of your earnings in your pocket. Vehicle and travel deductions go beyond just mileage. They're about making your time on the road work for you financially. Let's explore the options available and ensure you're taking advantage of every deduction you're eligible for. Vehicle expenses, mileage versus actual expenses. When it comes to deducting vehicle expenses, you have two options: the standard mileage deduction and the actual expense method. Each has its own benefits, and choosing the right one depends on your driving habits, vehicle type, and expenses. Standard mileage deduction. With the standard mileage deduction, you can claim a set amount per mile driven for business purposes. In 2024, this rate is 58.5 cents per mile note. Always check the current IRS rate. This method is simple and requires you to keep track of your business miles throughout the year. This is best for trainers who drive frequently for work or those with lower vehicle expenses. If you don't want the hassle of tracking every car expense, this option is straightforward. Actual expense method. With the actual expense method, you can deduct a percentage of your actual vehicle expenses, including gas, maintenance, repairs, insurance, depreciation, and even lease payments if applicable. To calculate this, you'll determine what portion of your total mileage is for business versus personal use, and then deduct that percentage of your total car expenses. This is best for trainers who have high vehicle expenses or drive a lot for personal reasons as well. This option works well if your vehicle is newer or requires more maintenance, making the deduction more substantial. Example. Let's look at Jordan, a personal trainer who uses his car to visit clients around the city. Jordan drove 6,000 business miles last year and 4,000 personal miles, totaling 10,000 miles. By opting for the actual expense method, he calculated that 60% of his vehicle expenses were for business. With costs like fuel, maintenance, insurance, and depreciation adding up to $5,000 for the year, he was able to deduct $3,000, 60% of $5,000, as a business expense, significantly lowering his tax liability. Keeping track of business mileage. Tracking mileage consistently is crucial to ensure you maximize your vehicle deduction and remain compliant in case of an audit. Here are a few ways to simplify mileage tracking. Mileage tracking apps. Apps like Millik or QuickBooks Self-Employed can automatically track your trips, categorize them as business or personal, and provide IRS-compliant records. Mileage log. If you prefer a manual approach, keeping a logbook where you record the date, purpose of the trip, start and end odometer readings, and total miles driven can work just as well. Make it a habit to record your trips daily or weekly. Waiting until the end of the month or year can lead to inaccurate records or missed deductions. Travel expenses. What qualifies as deductible? Vehicle expenses are just one part of the travel deductions available to you. Let's look at other travel-related expenses that trainers can deduct. Client visits and on-site training. Travel expenses incurred while driving to and from client sessions or on-site training locations are deductible. Workshops, seminars, and conventions. If you're traveling out of town for a fitness conference, workshop, or seminar, those expenses such as airfare, lodging, and meals can be deducted as business travel. Even transportation at your destination, like taxis or rideshares, qualifies. Scouting locations. If you're expanding your business by scouting locations for a new gym or studio, this travel may also qualify as a business deduction. Client-related errands. If you're picking up equipment or supplies specifically for your client session, that mileage can count as business use. Personal expenses, like vacations or personal portions of mixed-use trips, are not deductible. Only expenses incurred directly for business purposes qualify. Meet Lisa, a fitness coach who frequently drives to clients' homes and occasionally attends fitness conventions. Last year, she attended a 3-day wellness conference out of state, spending $500 on a flight, $300 on lodging, and $150 on meals. Lisa also drove 5,000 business miles to visit clients locally. For her local travel, Lisa chose the standard mileage deduction, claiming $2,925, 5,000 miles x 58.5 cents. For her conference expenses, she was able to deduct the flight, lodging, meals, and local transportation, adding another $950 in deductions. By keeping organized records and understanding what was deductible, Lisa saved a significant amount come tax time. Maximizing your vehicle and travel deductions. To make the most of your vehicle and travel deductions, here are a few tips that will help you keep more of your earnings. Separate business and personal travel. Deducting only business-related travel ensures compliance and maximizes your eligible expenses. Plan for business trips. Whenever possible, combine multiple client visits or errands into a single trip. This saves time, and if the trip is primarily business-related, it maximizes the mileage you can claim. Record client-specific travel. If you're heading to a specific client's location, record it as a business trip. Every mile driven for your clients is money back in your pocket when tax season arrives. Save receipts for travel. For out-of-town travel, keep records of your airfare, lodging, and meals, along with any registration fees for workshops or seminars. Keeping clear documentation makes filing easier and prepares you in case of an audit. Common pitfalls to avoid. Mixing personal and business mileage. Make sure to only deduct miles or expenses that are directly related to your business. This keeps your deductions compliant with IRS rules. Forgetting to track mileage regularly. Reconstructing mileage records after the fact is challenging and often inaccurate. Consistent tracking is key. Assuming all meals are deductible. Only meals incurred while traveling for business can be deducted, and even then, they're typically deductible at 50%. In summary, your vehicle and travel expenses can be a substantial deduction if you track and categorize them accurately. By knowing your options, whether it's the standard mileage rate or actual expenses, and keeping meticulous records, you can reduce your taxable income and keep more of your hard-earned money. Deductions for travel can really add up, especially if your business requires a lot of on-the-go client work or professional development. Embrace these savings opportunities and make each mile count as you build a stronger financial foundation for your business. Next, we'll move on to uncovering even more ways to save. Let's keep the momentum going and dive deeper into maximizing deductions as a fitness professional. Let's unlock the hidden potential of your branding investments. In this lecture, we're diving into uncommon deductions for marketing and branding ways you can grow your business's reach while saving on taxes. As a fitness professional, every expense you put toward building your brand, from apparel to advertising, has the power to become a tax-saving opportunity. Understanding these unique deductions will help you maximize both your brand impact and your bottom line. Branded apparel and uniforms. Branded apparel is one of the most overlooked deductions for fitness professionals. Clothing that bears your logo, business name, or tagline can qualify as a deductible marketing expense. Not only does it promote your brand, but it also helps you create a professional image that attracts clients. What qualifies? Items like t-shirts, hoodies, and hats with your logo or business name, as long as they're worn for business purposes. Keep your branded clothing exclusively for business use to ensure it qualifies as a deduction. Document when and where you wear it to strengthen its business purpose. Imagine you spend $250 on branded t-shirts and hoodies to wear while training clients. Because these items serve as marketing tools, they're deductible as advertising expenses, effectively reducing your tax burden. Social media advertising and content creation. Social media is a key tool for fitness professionals, and the good news is that your advertising costs here are tax deductible. Whether it's promoting posts, running ads, or creating engaging content, these expenses are recognized as legitimate marketing costs. Deductible expenses: fees for Instagram, Facebook, or YouTube ads, professional photography, videography, and subscriptions to content creation tools like Canva. Keep records of each ad campaign, noting the objective and outcome to back up the business purpose of the expense. If you spend $150 on Instagram ads and $100 for a photographer to create content, these costs reduce your taxable income. By promoting your services online, you're expanding your reach and investing in your brand's growth, all while saving on taxes. Sponsorships and event participation. Attending or sponsoring fitness events is a smart way to connect with potential clients, and these activities are deductible as marketing expenses. From local wellness fairs to industry conferences, your event participation builds brand visibility and is fully deductible. Deductible items: booth fees, branded giveaways like water bottles or wristbands, banners, and any promotional materials. Be strategic with sponsorships to align your brand with events that will reach your target audience effectively. If you sponsor a booth at a local wellness fair for $400 and spend $100 on branded water bottles to give away, you're enhancing your brand and reducing your taxable income. Both costs qualify as advertising expenses, benefiting your business in multiple ways. Professional photography and video production. High-quality visuals are essential for marketing your services in today's competitive fitness industry. If you invest in professional photography or videography to capture your sessions or create promotional material, these expenses are deductible. What qualifies? Photographer and videographer fees, editing services, and even studio rental if you need a professional space for your shoot. Keep receipts and note where the images or videos are used, whether on social media, your website, or in printed materials to reinforce the business purpose. Suppose you hire a videographer for $500 to create a promotional video of your unique training style. Since this content promotes your services, it's deductible, lowering your taxable income while boosting your brand's reach. Website and branding design. Your website and digital presence are a critical part of your brand, and any investment in design, maintenance, or updates can be claimed as a business expense. This includes web design fees, domain registration, and the cost of hiring graphic designers. Deductible expenses: website design, hosting fees, content creation, and branding updates. Record all fees associated with building or updating your website, as well as any digital assets used to enhance your branding. If you spend $1,000 updating your website's layout and adding new branded content, this cost directly enhances your business's reach and professionalism. You can deduct the full amount as a marketing expense, giving you both a brand and tax boost. Memberships and networking groups. Membership fees for professional organizations, networking groups, or industry-specific associations can also qualify as deductible marketing expenses. These memberships offer networking opportunities that help you connect with other professionals and potential clients. What qualifies? Fees for joining local fitness organizations, networking groups, or even virtual communities that expand your business connections. Note how each membership enhances your business, such as networking opportunities or visibility within the fitness community. Say you join a local fitness network for $200 per year. By connecting with other professionals, you expand your potential for client referrals. Since this membership directly supports your business, the fee is deductible, reducing your tax burden. Let's look at Maria's branding strategy. Maria, a yoga instructor, decided to elevate her brand by investing in a few marketing efforts. She spent $300 on branded leggings and tops, $500 for a website overhaul, and $200 on Facebook ads to promote her classes. Each of these expenses helped Maria build her brand presence and attract more clients. When tax season arrived, she deducted a total of $1,000 in marketing expenses, which not only lowered her taxable income, but also freed up more funds to invest back into her business. Best practices for claiming marketing and branding deductions. Document usage. Make a note of how each expense directly supports your business. This might include where you wore branded apparel or how a social media campaign drove new leads. Separate business from personal. Keep personal and business expenses separate, especially with branded items like clothing, to ensure only qualifying items are claimed. Leverage digital ads. If you're promoting on multiple platforms, track ad spend individually for easy deduction tracking. Use bulk purchases for giveaways. When attending events, consider buying promotional items in bulk. This saves money and simplifies receipt tracking for deductions. Avoiding common mistakes. Mixing personal and business expenses. Only deduct items used exclusively for business. If you wear branded clothing personally, it may not qualify. Forgetting smaller recurring costs. Subscriptions to content creation platforms or social media management tools are easy to overlook but are fully deductible. Overlooking documentation. Keep all receipts, invoices, and records of usage to back up each deduction's business purpose. In summary, your marketing and branding investments don't just build your business, they can also reduce your tax bill. By knowing which expenses qualify as deductions, you can maximize the return on your marketing efforts, keeping your brand visible and your tax burden lower. Every dollar you invest in your brand's visibility brings more than just client connections. It creates an opportunity to save on taxes. As we continue, we'll explore additional ways to reduce expenses and boost profitability. Let's keep finding ways to grow and optimize your business finances. In the world of fitness, cash flow is the fuel that keeps your business running smoothly. It's not just about earning revenue. It's about knowing how to manage the money coming in and going out so that you can operate without interruption, invest back into your business, and plan confidently for growth. In this lecture, we're going to explore the essentials of understanding cash flow, what it is, why it matters, and how to keep it under control. Whether you're running a one-person operation or managing a team, cash flow management gives you the stability to make strategic decisions without worrying about whether you'll be able to cover next month's expenses. What is cash flow? At its core, cash flow is the movement of money in and out of your business. Cash inflow is the money that comes in through client payments, sales of products, or other income. Cash outflow, on the other hand, is what goes out like rent, utilities, supplies, and any other business-related costs. Positive cash flow means you're bringing in more than you're spending, while negative cash flow indicates you're spending more than what's coming in. Understanding your cash flow helps you anticipate financial needs, avoid shortages, and make better business decisions. If you've ever had to delay a payment because you're waiting for clients to pay their invoices, you know how essential it is to keep cash flowing steadily. Why cash flow matters for fitness professionals. For fitness professionals, cash flow management is vital because of the industry's natural ebb and flow. Many trainers experience peak seasons like the new year or summer when clients are more motivated to achieve their fitness goals. During off seasons, however, income might slow down. Having a clear picture of your cash flow allows you to prepare for these fluctuations, ensuring you're financially stable year-round. Tracking cash flow. Tracking cash flow isn't just about knowing what you have in the bank today. It's about projecting future inflows and outflows to maintain financial stability. Here's how to start tracking your cash flow effectively. Create a cash flow statement. A cash flow statement is a tool that shows your business's monthly inflows and outflows. By tracking your cash flow monthly, you can spot trends, identify potential shortfalls, and make adjustments as needed. Separate fixed and variable expenses. Fixed expenses, like rent and utilities, remain the same each month, while variable expenses, like marketing or travel, can change. By distinguishing between these, you can more accurately predict cash flow and prioritize spending. Use software for simplicity. Tools like QuickBooks, Xero, or even a simple Excel sheet can help you automate cash flow tracking, making it easier to manage. Let's say you're a personal trainer with fixed expenses of $2,000 per month and variable expenses averaging $1,000. If you know your income fluctuates, tracking these figures helps you plan accordingly. During peak months, you might set aside extra cash to cover the quieter months, ensuring a smooth financial cycle. Tips for improving cash flow. Having a handle on your cash flow is one thing, improving it is another. Here are some actionable strategies to help you boost cash flow. Encourage upfront payments or prepaid packages. Offering clients the option to prepay for multiple sessions or packages not only secures future income, but also gives you immediate cash inflow. This can be particularly useful during slower months, when upfront payments provide a financial cushion. How to implement. Offer a slight discount for clients who buy sessions in advance. For example, give a 5% discount for a 10-session package. This can encourage clients to commit and brings cash into your business sooner. Invoice promptly and follow up on late payments. If you invoice clients or vendors, don't delay sending invoices after a session or sale. The sooner you invoice, the sooner you can expect payment. Likewise, follow up on any overdue payments to maintain steady cash flow. Set up automated reminders to follow up on unpaid invoices. Most accounting software offers this feature, reducing your workload and ensuring you're paid on time. Reduce unnecessary expenses. Regularly review your expenses to identify any costs that could be reduced or eliminated. Sometimes, small adjustments, like switching to a more affordable software or negotiating better rates with suppliers, can improve cash flow without impacting your business operations. Example: if you're subscribed to multiple digital tools, check to see if there's an all-in-one solution that could reduce your overall costs. These little adjustments add up over time. Plan for seasonality. If your business has seasonal highs and lows, plan ahead. During high seasons, consider setting aside a portion of your earnings to cover expenses during slower periods. This helps prevent cash shortages and allows you to maintain consistent operations year-round. Example: many trainers experience a surge in clients around January when people are focused on New Year's resolutions. Set aside a portion of January's earnings to cover leaner months like July and August, when client activity might dip. Cash flow forecasting. Cash flow forecasting involves projecting your future cash flow based on past trends and upcoming expenses. This helps you predict shortfalls and make adjustments before they happen, giving you a proactive approach to financial management. How to start. Begin by analyzing your cash flow history over the past few months. Identify patterns. Are there months where cash flow is higher or lower than usual? Use this data to project your cash flow for the coming months and prepare for any anticipated gaps. Adjust as needed. Cash flow forecasting isn't a set it and forget it process. Revisit your forecast regularly and adjust as your income or expenses change. Suppose you know that October is a slow month for new clients. By forecasting, you might recognize that your October cash flow could be tight. To prepare, you could run a special promotion in September to bring in extra cash or cut back on discretionary expenses in October. Let's look at Tom's cash flow strategy. Tom, a fitness coach, struggled with cash flow management when he first started his business. His income fluctuated month to month, and he found himself short on funds during slow periods. After implementing a cash flow strategy, Tom offered clients the option to prepay for monthly training packages, creating a steady inflow of cash. Additionally, he set up an automated invoicing system and reviewed his expenses, cutting out non-essential costs. By forecasting his cash flow, he was able to anticipate slow periods and plan accordingly, reducing financial stress and keeping his business stable. Tom's story illustrates how a proactive approach to cash flow can stabilize your finances, allowing you to focus on growth without being distracted by cash shortages. Best practices for managing cash flow. To keep your cash flow strong, here are some key practices to incorporate. Regularly review cash flow statements. Make it a habit to review your cash flow statement monthly. This provides insights into trends and lets you adjust your spending and saving accordingly. Build a cash reserve. Having a cash reserve for unexpected expenses or seasonal dips can prevent you from dipping into personal funds or taking on debt. Analyze income sources. Track which services or products generate the most income. By focusing on high-earning services, you can increase cash flow without adding significant new expenses. Set financial goals. Aim to improve cash flow by a certain percentage each quarter. Setting specific goals keeps you focused on strategies that contribute to financial stability. In summary, understanding and managing cash flow is about more than just keeping the lights on. It's about creating a reliable financial foundation that lets you make growth decisions confidently. By tracking, forecasting, and adjusting your cash flow, you empower your business to operate smoothly and be ready for any opportunities or challenges that come your way. Effective cash flow management is a game changer for fitness professionals. Let's take control of our finances, ensure stability, and set up our business for long-term success. Ready to keep building on this foundation? Let's move forward and dive deeper into strategies that strengthen your financial health. Keeping an eye on your business's health is about more than just knowing your income and expenses. Financial ratios give you a clearer picture of how your business is performing, helping you make informed decisions for sustainable growth. In this lecture, we'll explore key financial ratios that every fitness professional can use to measure business health. These ratios can alert you to potential issues, guide you in setting financial goals, and help you understand where your business stands compared to industry standards. Let's look at the essential ratios that can turn financial data into actionable insights. Current ratio. The current ratio measures your business's ability to pay short-term obligations with its current assets. It shows whether you have enough liquid assets, cash, or assets that can easily be converted to cash to cover liabilities due within the next 12 months. A healthy current ratio is generally considered to be 1.5 or higher. Formula: current ratio equals current assets divided by current liabilities. Ideal range: a ratio above 1 means you have more assets than liabilities, which is generally healthy. However, a ratio too high might indicate you're not using cash efficiently. Example: imagine your business has $10,000 in current assets like cash and accounts receivable and $6,000 in current liabilities like accounts payable and short-term loans. Your current ratio would be 10,000 divided by 6,000 equals 1.67, which indicates your business is financially stable in the short term. Tip: a low current ratio below 1 may signal cash flow issues, while a very high ratio could mean it's time to reinvest some assets for growth. Gross profit margin. Your gross profit margin shows how much profit you're making after covering the cost of goods sold, COGS. For fitness professionals, COGS might include expenses like gym equipment, apparel, or costs associated with training materials. The gross profit margin indicates how efficiently you're generating profit relative to the cost of providing services. Formula: gross profit margin equals revenue minus COGS divided by revenue times 100. Ideal range: profit margins vary by industry, but a higher gross profit margin generally indicates better profitability. Example: let's say you bring in $16,000 in revenue for the month, and your cost of goods sold is $4,000. Your gross profit margin would be $16,000 minus $4,000 divided by $16,000. Times 100 equals 75%. This means 75% of your revenue remains after covering your service costs, leaving room for other expenses and profit. Tip: monitoring your gross profit margin helps you determine whether your pricing or cost structure needs adjustment. If your margin is too low, consider reevaluating your expenses or pricing to improve profitability. Net profit margin. While gross profit margin focuses on your cost to deliver services, the net profit margin shows what you keep after all business expenses are covered. This includes overhead costs, marketing expenses, and taxes, giving you a clear picture of your business's overall profitability. Formula: net profit margin equals net income divided by revenue times 100. Ideal range: typically, a higher net profit margin indicates a healthy, profitable business. Aim to improve this ratio by managing costs and maximizing revenue. Example: if your total revenue is $16,000 and your total expenses, including rent, salaries, marketing, and taxes, are $12,000, your net income is $4,000. So your net profit margin is 4,000 divided by 16,000. Times 100 equals 25%. This means you retain 25% of every dollar earned, which contributes to growth or savings. Tip: regularly tracking net profit margin helps you identify areas where you can reduce expenses or increase revenue, optimizing overall business profitability. Debt to equity ratio. The debt to equity ratio shows the proportion of your business's financing that comes from debt versus your own investment equity. This ratio indicates how reliant your business is on borrowed funds, helping you gauge the level of risk associated with your debt. Formula: Debt to equity ratio equals total liabilities divided by owner's equity. Ideal range. A ratio between 0.3 and 0.6 is generally considered healthy. A lower ratio means you rely more on your own investment, while a higher ratio indicates a dependence on debt. Example, if your business has total liabilities of $8,000 and owner's equity of $20,000, your debt to equity ratio is 8,000 divided by 20,000 equals 0.4. This suggests a balanced approach to financing, as you're not overly reliant on debt. Tip: a high debt to equity ratio can signal risk, especially during slow periods. Aim to keep this ratio balanced, using debt strategically without putting too much strain on your finances. Client retention rate. Though not a traditional financial ratio, client retention rate is crucial for fitness professionals. This metric reflects your ability to keep clients over time and directly impacts cash flow, profitability, and growth potential. Formula: client retention rate equals number of clients at end of period minus new clients acquired divided by number of clients at start of period times 100. Ideal range: the higher, the better. A high client retention rate indicates strong relationships and consistent cash flow. Example: let's say you started the month with 50 clients, gained 10 new clients, and ended the month with 55 clients. Your client retention rate is 55 minus 10 divided by 50 times 100 equals 90%. This high retention rate shows client satisfaction and stability in your cash flow. Tip: if your retention rate is low, it may be time to reevaluate client engagement strategies or improve your offerings to encourage long-term loyalty. Return on investment (ROI). The return on investment (ROI) measures the profitability of specific investments, like marketing campaigns, new equipment, or training certifications. Understanding ROI helps you make smart investment choices that maximize returns and contribute to business growth. Formula: ROI equals net profit from investment minus cost of investment divided by cost of investment times 100. Ideal range: positive ROI is always ideal, but target ROIs will depend on your business goals and industry standards. Example: suppose you invested $500 in a social media ad campaign that generated $1,500 in new client revenue. Your ROI is $1,500 minus 500 divided by 500 times 100 equals 200%. This high ROI shows that your marketing investment paid off well. Tip: consistently track the ROI of all major investments to understand which strategies contribute most to profitability. If an investment's ROI is low, reconsider its value or look for alternatives that yield better returns. Here is Sarah's financial ratio checkup. Sarah, a fitness coach, uses these financial ratios to keep her business on track. She calculates her current ratio monthly to ensure she has enough cash on hand, monitors her net profit margin to maximize profitability, and checks her client retention rate to track her success in keeping clients long term. Last year, Sarah invested in a local advertising campaign and tracked its ROI, discovering it generated a 150% return. By using these ratios, Sarah has a clear view of her business health, helping her make smarter, more profitable decisions. Sarah's approach shows how each ratio works together to create a full picture of business performance. By monitoring these metrics regularly, she stays financially proactive, adapting her strategies based on data rather than guesswork. Best practices for tracking financial ratios. To maximize the benefits of using financial ratios, consider these best practices. Regularly review ratios. Calculate key ratios monthly or quarterly to catch any changes in your business's financial health early on. Set benchmarks. Compare your ratios to industry standards or your own goals. Setting benchmarks gives you a target to aim for and helps you measure progress. Use ratios for decision making. Use these metrics to inform decisions about hiring, marketing investments, or expansion plans. Ratios help ground your decisions in data. Adjust based on findings. If your ratios reveal potential weaknesses, take action. A low net profit margin might mean cutting unnecessary expenses, while a low client retention rate could lead you to improve client engagement strategies. In summary, financial ratios are powerful tools that provide insights beyond basic profit and loss statements. They're like a health checkup for your business, giving you the information needed to optimize growth and stability. By understanding and tracking these ratios, you can make data-driven decisions that set your business on a path to success. Strong financial health isn't about revenue alone. It's about knowing where your business stands and what it needs to thrive. By leveraging these ratios, you gain the tools to create a stable, profitable business that's ready for whatever the future holds. Let's keep building your financial toolkit and dive into more strategies for long-term success. Building a financially healthy business isn't just about cutting costs or increasing rates. It's about thinking outside the box and implementing strategies that work for your unique business. In this lecture, we'll explore creative strategies for improving financial health ideas that go beyond the basics to help you optimize cash flow, increase profitability, and create new income streams. These strategies are designed to empower you to make smart financial choices that fuel growth and stability. Let's get creative and discover ways to maximize your financial health while enhancing your business's value. Offer tiered membership packages. One powerful way to increase your revenue and create consistent cash flow is by offering tiered membership packages. Instead of providing a one-size-fits-all service, consider creating multiple membership levels that cater to different client needs and budgets. This strategy allows clients to choose a package that best fits their goals and encourages them to commit long-term. How it works. Offer 3 membership tiers: Basic, Standard, and Premium. Each tier includes additional benefits such as extra sessions, personalized plans, or one-on-one coaching. The higher the tier, the more personalized and intensive the experience, allowing you to charge accordingly. Let's say you offer a basic package with group sessions, a standard package with personalized training plans, and a premium package with one-on-one coaching and nutritional guidance. Clients who choose the premium option provide you with a steady income and help stabilize cash flow. Promote each package's unique value to ensure clients see the benefits of upgrading to a higher tier. Tiered pricing creates flexibility for clients while boosting your revenue. Introduce a referral program. Word-of-mouth referrals are one of the best ways to grow your client base, and a referral program is an excellent way to encourage existing clients to spread the word. This strategy not only brings in new clients, but also fosters a sense of community among current clients who feel appreciated and rewarded. How it works. Offer a reward, such as a free session, a discount, or branded merchandise for each referral a client brings in. Make the reward valuable enough to motivate clients to participate actively. Imagine you offer a free session for every referral that signs up for a package. Your clients are likely to spread the word if they know they'll receive a valuable reward, and the cost of the free session is offset by the revenue from new clients. Make the referral program easy to understand and promote it regularly. Display posters in your studio, share it on social media, and mention it during sessions to keep clients engaged and excited. Upsell and cross-sell services. Upselling and cross-selling are effective strategies to increase revenue by offering clients additional services or products that complement their existing sessions. For example, if a client is working with you for training, you could offer them nutrition coaching or sell fitness products like resistance bands or supplements. How it works. Identify add-on services or products that can enhance clients' experience and results. Offer these at the right moment, such as during a consultation or after a successful session. A client signs up for personal training. You could offer an add-on package of 3 nutritional coaching sessions to help them meet their fitness goals. If the client accepts, it increases their total spend and they receive more comprehensive support. Make upselling natural and client-focused. Emphasize the additional value they'll gain from the service rather than simply the cost. Rent out space or equipment during off hours. If you have a physical location with equipment, consider renting it out during times when you're not using it. This can create an additional income stream, especially if you have popular equipment or a space that can be used for other fitness-related activities. How it works: offer the space for rent to other trainers, fitness classes, or local wellness professionals. Charge an hourly rate and set clear guidelines for use to protect your equipment and maintain professionalism. If you're closed on Sunday afternoons, you could rent out your studio to a yoga instructor. Charging $50 per hour, you add an additional $200 in weekly revenue. Reach out to other fitness professionals in your area to gauge interest and set up a rental agreement that benefits both parties. Build a subscription-based online platform. Consider creating a subscription-based online platform with on-demand workouts, nutrition guides, or wellness content. This platform can offer clients access to your expertise from anywhere at any time. An online platform allows you to generate passive income and reach a broader audience. How it works: charge clients a monthly fee for access to your content. The platform could include videos, meal plans, or workout schedules, offering something valuable beyond in-person sessions. You could create a $20 a month subscription for clients to access weekly workout videos and meal plans. Even with just 50 subscribers, that's an extra $1,000 in monthly revenue. Start with a small library of content and add more over time. This allows you to launch quickly and grow the platform based on client feedback. Host workshops or specialized classes. Hosting workshops or specialized classes can be a great way to boost revenue, especially if you focus on topics that are in high demand or unique to your expertise. Whether it's a strength training for beginners workshop or a mindful eating class, these events attract new clients and offer additional value to existing ones. How it works: schedule workshops during low traffic times to fill gaps in your schedule. Charge a set fee and promote the event as a special one-time opportunity. Imagine you host a 2-hour core strength bootcamp workshop on a Saturday. By charging $40 per participant and bringing in 15 people, you can generate $600 from one event. Offer early bird discounts or bundle workshop tickets with existing packages to increase sign-ups and reward loyal clients. Implement a loyalty program. Loyalty programs encourage repeat clients by rewarding them for their commitment to your business. This can include offering discounts, free sessions, or exclusive access to events for clients who reach a certain number of sessions or packages. How it works: design a points-based or session count-based system where clients earn rewards as they continue to train with you. It's a great way to increase retention and create a sense of community. For every 10 sessions completed, clients earn a free class or a discount on their next package. This reward reinforces loyalty and keeps clients coming back. Promote the loyalty program regularly and make it easy for clients to track their progress. Even simple incentives can be powerful motivators for ongoing engagement. Let's discuss Megan's multi-strategy approach. Megan, a personal trainer, wanted to improve her financial health without dramatically increasing her workload. She implemented several creative strategies. She offered a premium package for clients who wanted one-on-one coaching, launched a referral program with free sessions, and created a subscription-based online library with exclusive workout videos. Together, these strategies added over $2,000 to her monthly income, increased client loyalty, and diversified her revenue streams. By thinking outside the box, Megan was able to stabilize her cash flow, boost profitability, and attract new clients, all without sacrificing her core business focus. Her approach shows how multiple creative strategies can work together to support financial health. Best practices for implementing creative financial strategies. To make the most of these strategies, here are some best practices to consider. Monitor your results. Track the impact of each strategy on revenue and client satisfaction. This helps you identify which strategies are most effective. Start small and scale up. Test 1 or 2 strategies initially to see how clients respond. As you get comfortable, expand on what's working. Promote consistently, whether it's a referral program, loyalty rewards, or workshops. Consistent promotion keeps clients aware and engaged. Stay flexible. Be open to adjusting your approach based on client feedback. Flexibility allows you to refine strategies and maximize their effectiveness. In summary, improving your financial health is about making your business work smarter, not harder. These creative strategies allow you to increase revenue, reduce financial stress, and foster loyalty among your clients. By exploring options like membership tiers, referral programs, and online subscriptions, you're building a business that's adaptable and equipped for long-term growth. Financial health isn't just about income, it's about creating systems and opportunities that make your business resilient. Embrace these strategies and make each one a stepping stone toward a thriving fitness business, ready to bring even more financial resilience to your business. Let's keep building on these ideas and dive into additional strategies to maximize your business's potential. Every business faces risks, and as a fitness professional, it's essential to understand the risks specific to your industry. In this lecture, we'll explore the types of risks that can impact your business and how to start identifying them early. There are several types of risks that fitness professionals need to be aware of. Financial risks. Financial risks include anything that threatens the flow of income into your business. These can range from cash flow issues, economic downturns, or unexpected expenses such as equipment repairs. You need to have a plan in place to ensure that financial disruptions won't derail your business. Keeping an emergency fund, diversifying income streams, and regularly reviewing your financial health are key steps to mitigate financial risks. Legal and liability risks. As a fitness professional, you are at risk for legal issues, particularly if a client is injured during a session. To protect yourself, it's crucial to have client waivers in place and to obtain liability insurance that covers injuries and other claims. Make sure that your business complies with all local regulations and regularly review your client contracts to ensure they are up to date and protective. Operational risks. Operational risks refer to anything that disrupts the day-to-day operations of your business, such as equipment failures, natural disasters, or even a pandemic. Consider how your business could continue to operate in case of such events. Developing a disaster recovery plan, maintaining proper equipment maintenance schedules, and considering virtual offerings can help safeguard your business. Let us go over Rebecca's story. Rebecca, a personal trainer who operates her own studio, experienced a sudden drop in cash flow during a local economic downturn. Many of her clients lost their jobs and could no longer afford personal training sessions. Luckily, Rebecca had diversified her income by offering virtual training and selling online workout programs. These alternative income streams helped her keep her business afloat during tough times. Additionally, Rebecca faced a legal challenge when a client claimed to have been injured during a session. Because Rebecca had a signed waiver from every client and had obtained comprehensive liability insurance, she was able to resolve the situation without a major financial impact on her business. By identifying potential risks early, Rebecca was able to protect her business from both financial and legal challenges, ensuring that her operations continued smoothly, even in difficult circumstances. Mitigating risks is about taking proactive steps to protect your business from unforeseen events. In this lecture, we'll focus on specific strategies to minimize both financial and legal risks in your fitness business. Here are some key strategies for mitigating risks. Building an emergency fund. One of the best ways to protect your business from financial risk is to build and maintain an emergency fund. This fund should cover at least 3 to 6 months of operating expenses, including rent, payroll, and utilities. Having a cash reserve ensures that you can continue to operate even if your income dips temporarily or if you face unexpected expenses. Diversifying income streams. As discussed in earlier modules, relying on a single source of income can be risky. Adding additional income streams, such as online classes, merchandise, or group sessions, can help stabilize your cash flow. These streams can act as a safety net during slow periods in your main service offerings. Liability insurance and waivers. To protect your business from legal risks, it's essential to have comprehensive liability insurance. This insurance should cover any potential injuries or damages that occur during training sessions. In addition, client waivers should be signed before any session, clearly outlining the risks associated with physical activity. These waivers can serve as legal protection in case of injury claims. Here is Michael's story. Michael, a fitness coach, learned the importance of risk mitigation when his primary training studio experienced a flood. His business was shut down for over a month, which would have severely impacted his cash flow. However, because Michael had built an emergency fund that covered his rent and other fixed costs, he was able to continue paying his bills without going into debt. In addition, Michael had transitioned part of his business online prior to the incident, allowing him to offer virtual classes. His liability insurance covered the cost of damages to the studio's equipment, which would have been a massive financial setback otherwise. Michael's proactive planning and insurance coverage allowed him to avoid significant financial losses during a challenging time. Operational risks can strike without warning, but with proper planning, you can minimize their impact on your business. In this lecture, we'll discuss disaster recovery planning and how to protect your business from unexpected events like natural disasters, equipment failures, or pandemics. Here are 3 key steps for mitigating operational risks. Creating a disaster recovery plan. A disaster recovery plan outlines how your business will continue to operate in the event of an emergency. This could include natural disasters, equipment failures, or even personal emergencies that keep you from working. Your plan should include backup procedures for key operations, alternative workspaces, and contingencies for power or internet outages. Having a disaster recovery plan in place ensures that your business can quickly recover from unforeseen events. Regular equipment maintenance. Preventative maintenance is essential for minimizing operational risks related to your fitness equipment. Regularly inspect and maintain equipment to avoid unexpected breakdowns that could disrupt your services. Keeping a maintenance log can help you stay on top of equipment care and reduce downtime due to repairs. Adapting to virtual offerings. The COVID-19 pandemic showed how important it is to have virtual offerings in place. By creating online services such as virtual training sessions or recorded workout plans, you can continue to serve clients even if in-person sessions are not possible. This not only helps you maintain your income, but also expands your client base beyond your local area. Let's look at Jessica's story. Jessica, a fitness studio owner, never thought her business would be disrupted by a natural disaster. But when a major storm hit her town, her studio was severely damaged and she had to close for several weeks. Fortunately, Jessica had already developed a disaster recovery plan, which included renting a temporary space at a local gym and shifting many of her clients to virtual training sessions. Because she had a plan in place, Jessica was able to continue offering services without a significant loss of income. Jessica's experience also taught her the importance of regular equipment maintenance. After the storm, she invested in sturdier equipment and set up a regular maintenance schedule to ensure that her business would be better prepared for future events. With these proactive steps, Jessica minimized the impact of the disaster on her business and quickly got back to normal operations. As the year ends, your tax liability will depend on how well you've planned throughout the year. One of the most powerful year-end strategies is to maximize deductions. This lecture will show you how to accelerate expenses, use retirement contributions strategically, and defer income. These tactics can dramatically lower your taxable income and keep more money in your pocket. Let's explore 3 key ways to maximize deductions as the year closes. Accelerating expenses. If you expect a significant tax bill, consider bringing forward any planned business purchases. Equipment, marketing expenses, or software subscriptions can all be paid for in December rather than in January. By accelerating these expenses, you reduce your taxable income in the current year, which can lead to a lower tax bill. This method is particularly useful if you've had a profitable year. Even something like stocking up on supplies or preparing for services that will be used next year can count as an immediate deduction. Contributing to retirement accounts. One of the best year-end tax moves is to contribute to a qualified retirement plan like a SEP era or a solo 401k. These plans allow you to contribute a percentage of your income to a retirement account, which then becomes a tax-deductible expense. For example, if you're a personal trainer making $100,000, you can contribute up to 25% of your income to a SEP IRA, reducing your taxable income by $25,000. This isn't just a tax-saving measure, it's also an excellent way to secure your financial future. Deferring income. Another effective strategy is to defer income until the following year. Let's say you expect a large payment from a client in December, but you're nearing the top of your current tax bracket. By delaying the payment until January, you can shift that income into the next tax year, reducing your liability in the current year. This is particularly useful for fitness professionals with large one-time payments or bonuses. Let's look at Eric's story. Eric, a successful gym owner in Los Angeles, had a banner year with his fitness business. By November, he realized he was on track to face a higher tax bracket because of his unexpected profits from expanding his personal training business and launching a new online coaching platform. After consulting his accountant, Eric decided to take several key steps before year end. First, Eric purchased $8,000 worth of new gym equipment in December rather than waiting until January. This brought down his taxable income for the year by that amount, which saved him about $2,500 in taxes. Second, he contributed $20,000 to his SEP IRA, further reducing his taxable income by leveraging retirement savings. By accelerating these expenses and deferring a large client payment to January, Eric brought his taxable income down to a lower bracket, reducing his tax bill by more than $6,000. Eric's proactive approach helped him keep more money in his pocket and reinvest it into his business for future growth. As the year wraps up, organizing your financial records is crucial for tax filing. In this lecture, we'll discuss how to categorize your expenses, prepare documentation, and review year-end financial reports. By staying organized, you can make the filing process smoother and reduce the risk of missed deductions or errors. 3 key steps will help you organize for year-end filing. Categorize business expenses. Accurate categorization is key to maximizing deductions. Group your expenses into specific categories such as equipment, software, marketing, rent, travel, and professional development. Bookkeeping software like QuickBooks can automatically categorize transactions if set up properly, making tax time much easier. Categorization not only simplifies filing, but also helps you see which areas of your business are costing the most and where you can potentially save in the future. Prepare receipts and documentation. Throughout the year, you should be keeping digital or physical copies of every receipt related to business expenses. Come year end, it's time to make sure these records are in order. If the IRS ever questions a deduction, having proper documentation is essential. For fitness professionals, documentation could include receipts for equipment purchases, invoices for subcontractors, and records of home office expenses. Use cloud-based solutions or a simple filing system to ensure nothing is missed. Review year-end reports. Generate a profit and loss P&L statement from your bookkeeping system. This report will show you how much income your business brought in compared to its expenses. If you see that you've missed recording a few transactions, now's the time to enter them. A well-prepared P&L will give you an overview of your financial year and help you determine if any further tax-saving actions need to be taken before the year closes. Here is Sophia's story. Sophia, a fitness studio owner in New York, ran into trouble during her first year of operation when she failed to keep adequate financial records. At year end, she was overwhelmed, missing receipts, and unsure how to categorize many of her business expenses. This led to confusion during tax season and caused her to miss out on thousands of dollars in deductions. Determined to never let this happen again, Sophia invested in accounting software and started categorizing her transactions immediately. By the end of her second year, she had every receipt scanned, every expense categorized, and her profit and loss statement ready by the end of December. As a result, she found over $3,000 in business expenses she hadn't claimed in the previous year, including marketing costs, travel to a fitness conference, and new studio equipment. With this newfound organization, Sophia was able to reduce her tax bill and approach tax season with confidence. Filing your taxes strategically can significantly reduce your tax liability. In this lecture, we'll explore advanced filing strategies, including choosing the right business structure, making quarterly payments, and claiming often overlooked deductions like the home office and equipment write-offs. 3 important strategies to consider when filing. Choosing the right business structure. If your business has grown, it might be time to reconsider your business structure. Filing as a sole proprietor is simple, but may not be the most tax-efficient choice. Many fitness professionals choose to convert their business to an LLC, which offers more protection, or even to an S Corp, which can help reduce self-employment taxes. By paying yourself a reasonable salary and taking distributions from an S Corp, you can avoid self-employment taxes on part of your income. Making quarterly payments. If you're not making quarterly estimated tax payments, you could be hit with penalties at year-end. Calculating and paying estimated taxes each quarter ensures that you're staying ahead and avoid surprises when it's time to file. If you've had a particularly profitable year, be sure to check if your quarterly payments need adjusting. Claiming the home office and equipment deductions. If you use part of your home exclusively for your business, you can deduct a portion of your mortgage, rent, utilities, and even repairs. Similarly, equipment purchased for business use can often be written off in full thanks to Section 179. Make sure you know which deductions apply to you and have documentation to support them. Here is Julie's story. Julie, a personal trainer in Chicago, started her business as a sole proprietor, but quickly realized that this structure wasn't working for her as she scaled. With increasing income from both in-person training and online coaching, Julie was paying high self-employment taxes. After consulting with a tax professional, she switched to an S Corp, which allowed her to pay herself a reasonable salary and take the rest of her earnings as distributions. This simple change saved her over $5,000 in taxes, which she reinvested in marketing and equipment for her growing business. By being proactive about her tax strategy, Julie not only saved money, but also built a more financially sustainable business.